Stock markets are supposed to turn news into prices. A company reports profits, the price moves. But most daily price moves start somewhere else. They happen before news is read, before a human reacts, before an order reaches the market. They start deep inside servers, with machines reacting to other machines. Markets are treated as neutral tools for price discovery. In practice, speed and data-advantaged algorithms tilt outcomes every day. By the time information reaches you, prices have already moved, not because companies changed, but because systems reacted faster than people can. That gap drives modern market behavior. Modern stock markets are not one place. They are a network of public exchanges, private venues, and internal broker systems. Orders flow through brokers. They get routed to exchanges, dark pools, or market makers. Algorithms operate at every step. Some split large orders into smaller ones. Some provide liquidity, meaning they post buy and sell quotes. Some look for tiny price gaps across venues and trade them instantly. Most shares change hands without a human clicking anything. The system runs continuously at machine speed. What this means is simple. Price formation is a system process, not a single decision. Algorithms exist because the incentives reward them. Speed matters because being first captures the trade. A fraction of a second decides who earns the spread, the gap between buy and sell prices. Volume matters because exchanges charge and rebate per trade. More trades mean more fees collected or rebated. Risk matters because holding inventory is dangerous. Algorithms are built to hold positions for seconds, not years. The goal is not to predict companies. It is to minimize exposure and extract small, repeatable gains. That is why firms invest to shave microseconds. Because microseconds pay. These incentives create barriers. Competing requires expensive infrastructure. Firms pay for fiber routes, microwave towers, and server space next to exchanges. They pay for detailed market data feeds. They pay teams to tune models constantly. Capital requirements rise as volume rises. Only firms with deep balance sheets can absorb losses during shocks. Over time, this filters the field. Only a small group of firms can operate at full speed and scale. Power concentrates quietly through cost and access. What this means is not monopoly. It is structural dominance. Most algorithms react to prices, not businesses. They read order flow, quote changes, and volatility signals. Those signals mostly come from other algorithms. Liquidity appears when conditions are calm. It vanishes when models detect risk. When fear creeps in, many systems pull back at the same time. Spreads widen, prices jump faster. You've seen this happen before. On August 24, 2015, many popular stock ETFs opened at prices far below what the companies inside them were worth. To people watching, it looked like the market was malfunctioning. There was no major news, nothing fundamental had changed overnight. But to algorithms, volatility had spiked, risk limits were hit. So liquidity-providing systems stepped back at the same time. Buy and sell quotes widened or disappeared. Prices dropped not because companies were suddenly worse, but because fewer machines were willing to trade. Once volatility settled, liquidity returned and prices snapped back. The system didn't panic, it followed its rules. If you send an order in that moment, you are not reacting to news. You are entering a feedback loop already in motion. Price moves trigger exits. Exits cause bigger moves. Nothing is broken in isolation. The system behaves exactly as trained. Volatility rises without new information, because the system is responding to itself. Positions closest to order flow and execution benefit most. High-frequency trading firms capture spreads at scale. Large market makers earn from volume and rebates. Exchanges profit from activity, data sales, and connectivity fees. These gains come from position in the system, not prediction skill. Speed, scale, and centrality are the advantage. On the other hand, retail traders trade at prices shaped way before their orders arrive. Long-term investors experience sudden swings unrelated to fundamentals. That adds noise to execution and timing. Market transparency suffers. Prices increasingly reflect system reactions rather than shared interpretation. The loss is not just money. It is clarity about what prices actually signal. The system provides constant liquidity in normal times. Regulators rely on that stability. Market makers absorb flow others will not. That reduces visible friction. Changing incentives risks reducing participation. No regulator wants thinner markets. The infrastructure is sunk and political. Too many actors depend on it working as is, so the system persists. Not because it is perfect, but because it is integrated. Daily stock moves are not just information-driven. They are the predictable result of incentive-aligned algorithms, operating at speed, inside a structure built to reward reaction over reflection. On most days, prices do not tell you what companies are worth. They tell you how the system processed itself.